Good morning and welcome to TOI Japan Market Radio for Friday, November 21, 2025. I'm your host coming to you from Tokyo, and this is your daily briefing designed specifically for global investors tracking Japanese equities, currency, and rates. Today we're seeing some significant volatility across the board, so let's dive straight into what's moving markets. Joining me as always is our portfolio manager who focuses on Japan macro. Can you give us the headline numbers from today's session?
Absolutely, and it's been a rough day for Japanese equities. The Nikkei 225 closed down 2.405% at 48,625, which is the steepest single-day decline we've seen in several weeks. Interestingly though, the TOPIX was much more resilient, down just 0.058% at 3,457. Which tells us the sell-off was concentrated in large-cap export names rather than being broad-based. The Mothers Index, which tracks smaller growth companies, fell 0.914%. On the positive side, J-REITs actually gained 0.818%, closing at 2,033, likely benefiting from some safe haven flows within the domestic asset class. Meanwhile, the yen strengthened modestly with dollar-yen down 0.122% at 156.8.
So we're seeing this divergence between the Nikkei and TOPIX, which suggests specific sectors under pressure rather than a wholesale market rout. Let's unpack what's driving today's moves. The headline that's dominated trading desks is about AI bubble concerns combined with fears around potential yen intervention. Can you walk us through what actually happened here?
Sure, so we're really dealing with two separate but related anxieties. First, there's renewed concern globally about valuations in artificial intelligence-related stocks. Japan's market has significant exposure here through semiconductor equipment makers, chip suppliers, and electronics companies that have been riding the AI wave for the past year. When sentiment shifts on AI valuations globally, Japanese tech exporters get hit hard because their earnings multiples have expanded alongside their US peers. That's why you're seeing the Nikkei underperform the TOPIX today. It's the large-cap tech and export names that are taking the brunt of the selling.
And then layered on top of that, we have the intervention angle. What's the story there?
Right, so Japanese officials have significantly stepped up their verbal intervention in currency markets over the past 24 hours. We've had multiple statements from policymakers expressing concern about yen weakness. This coordinated messaging is clearly designed to talk the yen higher without actually having to spend reserves on direct intervention. The market is taking this seriously because persistent yen weakness has become a real policy headache for Tokyo. When the yen is weak, it drives up import costs, particularly for energy and raw materials, which feeds directly into domestic inflation. So officials are signaling they view current levels as undesirable and they're prepared to act if necessary.
So for global investors who are long Japanese equities, this creates a bit of a dilemma. Typically a weaker yen is seen as supportive for exporters, but now we have officials pushing back against that. What's the net impact on the equity market outlook?
It's definitely a mixed picture. If the yen does strengthen from here, that's traditionally a headwind for Japan's big exporters, think companies like Toyota, Sony, Panasonic, because it reduces the yen value of their overseas earnings. However, there's a counter-argument that a stronger yen could actually be supportive for the broader market. It would reduce inflation pressures, which helps domestic consumption, and it would benefit importers and domestic-focused companies. So we might see a rotation within Japanese equities rather than a wholesale decline. Cyclicals and domestic names could outperform while the export-heavy Nikkei 225 underperforms. That divergence we saw today could continue.
Staying with the yen theme, let's talk about the currency itself. We saw dollar-yen come off a bit today to 156.8. Is this verbal intervention likely to have legs, or are we just seeing a temporary pullback?
Well, the effectiveness of verbal intervention really depends on whether the market believes authorities will follow through with actual intervention if needed. Right now, the messaging is credible enough to create some two-way risk in dollar-yen. Traders who were positioned for further yen weakness are taking some chips off the table. If we do see actual intervention, buying yen and selling dollars, that could accelerate the move and push dollar-yen significantly lower from current levels. The key level to watch is probably around 155. If we break below that, it would signal a more meaningful shift in the currency regime.
And what does this mean for your outlook on Japanese government bond yields?
This is where it gets interesting for the rates market. A stronger yen tends to reduce imported inflation, which in turn lowers domestic inflation expectations. That's supportive for JGBs. It keeps yields anchored lower and reduces pressure on the Bank of Japan to normalize policy more aggressively. We've already seen some compression in yields today as the risk-off tone drove safe haven demand. If the yen continues to strengthen, the 10-year JGB yield could remain well contained, and it might actually push out market expectations for the next BOJ rate hike. So paradoxically, yen strength could delay monetary tightening, which would be positive for duration.
Let's broaden out a bit now and look at the global context. We're seeing world stocks track Wall Street's drop, essentially erasing the previous day's gains. How much of today's move in Japan is homegrown versus simply following global risk-off sentiment?
That's a crucial question, and honestly it's probably more about global contagion than domestic factors. Japan's equity market is extremely sensitive to Wall Street momentum. There's a very high correlation, especially in the large cap space. When US equities sell off, particularly in the tech sector, Japanese stocks tend to amplify that move because of their heavy weighting in technology and cyclical exporters. What we're seeing today fits that pattern perfectly. The Nikkei's 2.4% decline is in line with what you'd expect given the weakness overnight in US futures and the broader deterioration in risk appetite globally.
So if this is a global risk-off environment, what are the typical implications for Japanese assets beyond just equities?
Well, in a classic risk-off scenario, the yen typically strengthens as investors unwind carry trades. A lot of speculative positioning over the past year has involved borrowing in yen at low rates and investing in higher-yielding assets elsewhere. When risk appetite deteriorates, those trades get unwound, which means buying back yen, and that supports the currency. We're seeing a bit of that today. On the rate side, risk-off usually means a flight to safety, so demand for government bonds increases. JGB yields should compress in that environment, and we are seeing modest support for JGBs today. The 10-year yield is likely a few basis points lower, although the move hasn't been dramatic.
Now, one of the things that stood out to me in today's data was the relative strength in J-REITs. They were actually up over 0.8% while everything else was red. What do you make of that?
That's a good catch, and it probably reflects a couple of things. First, J-REITs are seen as a domestic defensive asset class with relatively stable income streams, so when there's volatility in equities, some investors rotate into REITs for that yield and stability. Second, if the expectation is that the BOJ will remain accommodative for longer, which is implied by the yen intervention narrative, that keeps financing costs low for REITs, which is structurally positive for the sector. So J-REITs can actually benefit from the same factors that are weighing on exporters. It's another example of that domestic versus export divergence we've been discussing.
Let's talk about the path forward for the rest of this week and into early December. What are the key things global investors should be monitoring?
I'd highlight three main areas. First, watch global sentiment around AI and technology valuations. If we see a sustained correction in US tech, Japanese equities will struggle to decouple, especially the Nikkei 225. Second, pay close attention to any official communications from Japanese policymakers regarding the currency. If we get another round of strong verbal intervention or hints at actual market intervention, that will move dollar-yen and have knock-on effects across asset classes. Third, keep an eye on economic data out of Japan, particularly inflation prints and consumption data, because that will shape expectations for BOJ policy normalization. Right now the market is in a bit of a wait-and-see mode on whether the BOJ hikes again in the first quarter of next year.
And just to be clear for our audience, when we talk about intervention or BOJ policy, we're not making any specific trade recommendations here. This is about understanding the macro backdrop and the risks.